Okay, dear students, this is Mustafa Mirchawala, your TX trainer, and today we are going to discuss pre-mock for December 2025 attempt MCQ section. Okay, and yes, students say sometimes that these MCQs are quite dodgy, so we need to be very active, but the basic objective of these classes is to give you guys motivation, right? And the biggest motivation is in front of you. Our team has compiled a few position holders of taxation, although it's not complete. So they have compiled 34 only TX position, although I teach FR, SBR, FA, other papers as well, but in TX we have like 34 positions and still it's not complete. And you can see there are world top in this as well. See this Maheen, Saqib Qayyum, Muhammad Ali Mirani, Faisal Rajat, these are world top. Means these students defeated 180 countries student in one single attempt. So it's a big motivation. When they can do, you can also do. I hope you guys will also join this list and give me happiness, right? So without wasting any time, let's move on to our questions. So we have this MCQ number 1. Fatma is a sole trader and pays tax under self-assessment. She made the following payments for the tax year 24-25. Now, you know, in any given tax year, there are total 3 tax payments. This question is about self-assessment individual. For in any given tax year, there are 3 tax payments. First payment on account, second payment on account, and then balancing payment. Let me make the schedule for you. Let me make the sketch. So hope you remember, if I'm talking about 24-25 fiscal year, so 24-25 fiscal year start on 6th April 24 and it ends on 5th April 25. This is your fiscal year. Okay, now listen. You know how to plot the POA. The first POA is always in between the fiscal year. This is 31st of January 25. This is your first POA, the due date for first POA, 24-25. Then after 6 months, 31st July 25, this is your second POA. And then after 6 months, that is 31st of January 26. This is the date of balancing payment. This is the date of balancing payment, right, of 24-26. Now, these are the due dates. Now what I say, that see, she made the following payments for the tax year 24-25. First payment on account 3700, but he paid on 1st of January 25, 1st of June 25, 1st of June 25. That means she should have paid this on 31st January 25. This is the due date. This is the due date for first payment on account, but she paid on 1st June. That means how many months late? Let me tell you. After 31st January, it's Feb, March, April, and May. Yes, end of May, 31st May or 1st June, we call it, right? So 4 months late. That means the first payment is 4 months late. Now, second payment on account, she paid on 1st June 25. That means she paid a little early. Doesn't matter. If you pay early, you won't get any benefit. But if you pay late, you have to pay late payment of interest. Okay, late payment interest on POA. So for the second payment, there is no penalty, but still you won't get any relief. On the third, then balancing payment is on exactly on the date, so no problem. So now you tell me, out of these 3 payments, which payment on is late? Only the first payment on account is late 4 months. First payment on account is late 4 months. Hope you remember the lecture. Whenever you pay payment on account late, whenever you submit or pay POA late, you just have to bear interest. You just have to pay late payment interest, and which is for this attempt, for your current attempt, it's 7.75%. 7.75%. Okay, so how much is the amount of first POA? It's 3700. So you paid this 3700 amount 4 months late. You paid 3700 pounds 4 months late. So what will be the late payment on interest? POA is 3700 into the annual rate is 7.75%. This 7.75% is for the whole year, but we are only 4 months late. We are only 4 months late, so it's going to be 287. This amount is 287. So how much late payment interest will Fatma will have to pay in relation to the tax liability? This 287. Now what about the other payments? They are on time or they are paid before the time, so no problem. There is no interest, no late payment on interest for the two second payments. Only the first POA is late. 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 Now, next question. This is related to the employment income. Very good question. Employment income question. Employment income question. Listen. Which two of the following statements concerning the tax treatment of company's car provided to employee are correct? Company's car provided to employee. So it's a benefit. In short, it's a car benefit. Remember the word car benefit. Okay. So which two of the car benefit is based on the list price when the car was first registered? Looks correct. Why? Remember, whenever you need to calculate, hope you remember the classes, whenever you need to calculate car benefit, you need to calculate the cost of the asset packet, and in the cost of the asset packet, the first thing is list price. Okay, the list price. So this is correct. Now, if a car is more than 6 years old when it was first provided to an employee, the benefit will be based on the value. No, this point is related to property. Hope you remember the accommodation benefit. Accommodations. You know, this is the practice of your examiner. He tries to mix different topics. Sometimes examiner gives you corporation tax things and individual things in cost. So they need to play with your mind. They need to check your memory. Okay, that's why I have recorded a class for the differences between individuals and corporation tax. Individual tax and corporation tax difference is very valuable class. It's on my YouTube as well. So this point is linked to accommodation benefit, not car benefit. If the employer purchases a car for less than list price, the car benefit is based on the no. It should be, remember, it should be before list price before trade discount. Hope you remember the lecture. List price before trade discount. List price before trade discount. So this is wrong. Means if the list price is 1000 but employer got it for 800, still you need to take 1000. So this one is also wrong. If accessories costing 150 are purchased and fitted to the car, the cost is ignored. No, there is no 150 limit in this topic. Yes, there is 150 limit for staff parties. Hope you remember the exempt benefit list. They are mixing up here. The cost of insurance paid by the employer is treated as a separate. No, it's insurance is exempt. Even when I was teaching this topic in the class, when I teach this topic in the class, I say like this, that already the car benefit and fuel benefit is extremely burdened, that now if employer insures your car, so it's exempt benefit. Okay, not taxable. The cost of providing a chauffeur is driver, is treated as a separate. Yes, driver is full-time taxable. Benefit. And yes, when I was teaching in the class, I gave you this logic that in UK, I'm not talking about Pakistan or India. In UK, driver is a very big luxury, very rich people uses driver. Okay. So it's taxable, it's not exempt. So 1 and 6, these two are correct. Next. Now, my dear students, the next question is linked to your capital allowances. I sometimes say that it's a very scoring area. Without this capital allowances topic, the paper is F6 paper is incomplete. So Ravi is a sole trader preparing accounts to 31st March each year. Year means 12 months. So it's a 12 months accounting period on the accrual basis. On 1st May 20, he purchased new office furniture. Yes, furniture is not a car. Furniture is not a car. So yes, it is eligible for AIA. Furniture is not a car. So yes, it is eligible for AIA. So yes, if through AIA, it will go 100% as in the allowance column. On 1st November 2024, he bought a second-hand electric car for 22,000, zero CO2 emissions. Listen, the car is used solely for business purposes. Listen, as this car is second hand, with zero CO2 emission, as this car is second hand with zero CO2 emission, the car is used solely for, as this car is second hand with zero, so it will go in the main pool. Okay, it will go in the main pool. So, and yes, it is a car, so no AIA on cars. Remember the famous dialogue. So let's do it. So first of all, I will write like this: furniture, it's 15,000. Yes, it will be covered with AIA. So this 15,000 will as it is go in the allowance column. 15,000 complete allowance. Yes, you have like big amount of AIA available, so 15,000 is nothing, easily will go in the allowance column. Now the second thing is this car will go in the main pool. The cost of the car is 22,000, and you know WDA for main pool, the WDA is 18%. And yes, as it is a complete 12 months accounting period, 12 months, so you don't need to apportion this WDA. So 22,000 times 18%, 22,000 times 18% is 3960. So this 3960 will come in the allowance column. Now can you total it? Yes, the total allowance is 15 plus 3, 18,960. This is the answer. 18,960. So very simple, old things, that the car is a main pool car and the furniture is completely AIA. So not difficult, be confident, together we'll do it easily. Okay, next, Omar seized. See the word Omar seized. Seize means the closure of business. So if a business is going to be closed and in the last accounting period there is a trading loss, that is called terminal loss. And Omar is a human being, human. So individuals, trading loss, terminal loss. Wait. So it's 24-25 fiscal year. Then you have 23-24. 22-23 and 21-22. See, in the very year ended 31st March 25 means this is 24-25 fiscal year. There is a 63,000 trading loss. Okay, now if you know the rules for individuals, I'm not talking about companies at all. For individual, terminal loss can go back 3 fiscal year in last in first out, and it will only cancel the trading profit of last 3 fiscal year. It will only cancel the trading profit of last 3 fiscal year. Okay, so this is 12,000 trading profit. In 2020-23 you have 36,000 trading profit. Be active, you have your paper now. And then 45,000. Now how it will work? Terminal loss can only cancel last 3 fiscal year trading profits. Okay, so out of this 63,000, listen, 12,000 will be used here and 36,000 will be used here. So 63 minus 12 minus 36. 63 minus 12 minus 36. 63 minus 12 minus 36 will give you 15,000. So how much amount you can use here? This is the question. If Omar makes a terminal loss relief claim to use his loss as early as possible, how much loss will be set off against his income for the tax year 21-22, for the tax year 21-22. So basically the examiner is asking how much terminal loss, how much terminal loss we can use here. Very simple answer, that we can only use 15,000 here. Why? Because the order is last in first out. The order is last in first out. So first you will cancel this, then this. So after cancelling these two, only 15,000 terminal losses left. So yes, in 21-22 you can only set off 15,000. This is the answer. Answer is A. Answer is A, right? Okay. Yes, there is a property income also given in the question C, which is irrelevant. Property income is irrelevant. No relevance of property income in this question, because we, in the requirement, they openly told you the terminal loss relief will be used. So individuals terminal loss relief can only cancel trading profit of past 3 fiscal year. Done. Next, let's move for the next question. Yes. Identify by clicking the appropriate box whether the following would represent tax avoidance or tax evasion. You know, tax avoidance is like a legal way of reducing tax, and tax evasion is illegal. One more definition: if you caught doing tax evasion, you will be penalized. You will face consequences. But if somebody pick your tax avoidance, it's okay, nothing, no problem. Okay, delaying the sale of an asset until the following tax year to benefit from additional annual exempt amount. Yes, this is avoidance. This is excellent. If you are on the revision days section, if you have done the exam kit, you are going to sell an asset in current fiscal year, like in 1st April 25. 1st April 25 means 24-25 fiscal year. But if you delay it 5 or 6 days, so that means this asset will be considered as a sale in the next period. So next period means the new annual exemption will be available, and using the new annual exemption will reduce your tax, So this is perfectly, this is planning, this is using your mind. Perfect. Including the gain on the sale of an asset by husband on his wife. No, this is wrong. How is it possible that husband gain is recorded in the wife? That is not allowed. That is not legal. But yes, it should have been done in such a way that husband should give gift to wife, no gain, no loss, and then wife should have sold it. Then it's okay. But how is it possible that the gain belongs to husband and now we are showing in the wife's tax return? It's wrong. That is wrong. Yes, that it can be corrected in such a way that before selling, husband is going to, in reality, husband was selling the asset. So husband should have sold this asset to wife first. So no gain, no loss between husband and wife, and then wife should have sold. But this time it's wrong. Transferring saving from bank account into ISA. Yes, in my class I have given this example. If you put your money in a commercial bank, normal commercial bank, the interest income will be your taxable income. But if you put it in individual saving account or NISA, NISA, then it's exempt. So it's tax avoidance, it's legal. Taking advantage of a loophole in the tax law to save. Yes, I have given this example as well. I'm also a teacher of IFRS. So, there are certain accountants, very sharp accountants, very active accountants. So when there is a loophole, when there is a deficiency in the IFRS, so they apply IFRS, and they also in the same time they fulfill their objectives of creative accounting. But later on, when the International Accounting Standard Board comes to know about that defect, they update the IFRS, they update the standard. Okay, you know that. Same is the case that these tax laws are prepared by human beings, and human beings are not perfect. So if there is a weakness in the law, you can take the benefit, and that means you will say, see, I am fulfilling the law, I am fulfilling the law. Then in that case, nobody will touch you. Okay, so this is the answer. I have just done it. So next question. Quantum limited. Now what is the question? There are two types in corporation tax when it comes to paying the tax. So one is large and one is a small company. Large company pays tax in installments. Large companies pays tax in installment, and small company pays tax by in within 9 months in one single payment. 9 months and 1 day after the end of accounting period. 9 months plus 1 day. 9 months plus 1 day, remember. But the large company pays tax in 4 installments. Hope you remember. So there was a topic, I hope you remember it, you did in class, that sometime you are large in current year, you are large company, but still you are exempt from installments. You don't need to pay tax in installment. And what is the condition? Last year you are not large. Last year you are not large. But if you are large in the last year, then this year no exemption for you. Okay, so let's see. Quantum company has 2 associated companies for many years. So this is Quantum and the 2 associate companies like 100% subsidiaries, for example, just A and B. So the total members in the group are 3. Total members in the group are 3 many years. So the limit is 1500,000. The limit is 1500,000, and limit is apportioned by the total members. So your limit is 500,000. For this question, in both accounting period, your limit is 500,000. Now, if your augmented profit is greater than this limit, then you are a large company. If your augmented profit is greater than the limit, then you are a large company. Let's see. So for the tax year 2025, the taxable, the TTP is 960. Yes, current year you are large, greater than 500. Current year you are large, but let's see the last year. For the year ended 31st March 2024, again it's 630, means it's greater than 500. So last year you are also large. Current year you are large. See, right now you are large. And last year also you are large. So no exemption at all. No exemption at all in the current year from installments. Yes, you need to follow the installment process. Now what is this? How to calculate the installment? Let me tell you. What are your current, see, we only use this, the current year TTP. It's 960. Now first calculate the complete corporation tax. As you are a large company, as you 960,000 means you have to pay directly 25%. For calculation of tax, 960,000 is greater than the corporation tax limits as well. So you are a large company, you need to pay exactly 25% tax without any marginal relief. So 960,000 times 25%. 960,000 times 25%. This will be 240. Total amount is 240. Total corporation tax is 240. And yes, for a 12 months accounting period, there are total 4 installments. So divide by 4. The per installment is 60,000. 60,000 per installment. 60,000 per installment. Hope you remember. Hope you got it. Okay. So the answer will be how Quantum Limited pay its corporation tax liability for the year ended 31st. See, 4 installment of 60,000 each. This is the answer, right? See, they are making you fool. The balancing, this balancing payment word is not for companies, it's for individuals, right? And one payment is impossible. One payment only, we do one payment in case we are a small company, we are a large company. Dear student, we are large. So large company pays tax in 4 installments if the accounting period is 12 months. Hope you remember, these are the topics which are tested. So please check it out. Check it out. Okay, one more question. Yes, horizon limited. See, next question is horizon limited. We are in corporation, not individuals. Okay, so the two accounting periods in front of you, the first is 31st March 2025, the other is 31st March 24. Okay, can you see these two periods? Yes, you can. So you have a trading loss of 86,000. This trading loss we need to use. Now, hope you remember the classes. For companies, trading loss can be set off in current year total profit, and if you are going to use in current year, you need to set off complete total profits and your QCD will be wasted. Means no partial claims. Means no partial claims. Okay, now next thing is the remaining amount will be set off in last 12 months. The remaining amount will be set off in the last 12 months total profits. Again, last total 12 months, no partial claims, your QCD will be wasted. Yes, then your remaining amount will be carried forward. Okay, so what they are saying, see, what is the amount of unused trading loss Horizon Limited can carry forward to the year ended 31st March 2026 in future, assuming, see the word, assuming it claims loss relief as soon as possible. Loss relief means current year and 12 months back. Okay, so let me make this for you. I'm writing here 86,000. Normally they write 0. 32,000 here. Then you have property income 7,600 and 9,800. And then you have gains 15,000. And I would write here 0. Listen, in reality there was a capital loss. Can you see there is a capital loss of 2,000? See this, there is a capital loss of 2,000 in March 25. Now listen, let me give you a recall. Capital loss can only set off capital gains, the first thing. So in the current year, that is 31st March 25, there is no other capital gain. So this capital loss cannot be used in current year, number one. Number two, capital loss cannot be carried back. So that means it won't go back. So that means we will not be able to use our capital loss now. Yes, it will be carried forward for future. Capital loss will be carried forward for future, and it can only set off capital gains, no other income. So let's put this in dustbin, leave it. Okay. Now, so let's calculate the total. See, this 86,000, although I have written the loss, but whenever we calculate total income, one loss cannot cancel the other gain. So this 86,000 will be recorded like a 0 right now. Okay, so 9,800 plus 0 is 9,800 total profits. And if I come here, so my total profit will be 32 and 15 and 7,600, 54,600. Okay, now let's start using it. So this 86,000, this 86,000, let me just for you. First of all, it will set off this current year 9,800 and your QCD will be wasted. QCD wasted, let me write here. And then the remaining amount will go back here, and this 54,600, again your QCD for this year will be wasted. Why? because there is no partial claims for current year and 12 months back. Okay, now let's make a loss summary. So loss summary would say out of 86,000 trading loss, in the year 25 you used how much? 9800. In the last 12 months, year 24 you used 54,600. Now after using current year and 12 months back, this is the question, after using in current year and 12 months back, how much loss is left? And that loss will be carried forward for future. This will be 21,600. 21,600. This will be 21,600. 21,600. Right? So 21,600 will be carried forward for future, and this is the requirement, and this is the answer. This is the answer. But yes, for this, all these things you must have done the normal classes, the basic rules you know. What is the amount of unused trading loss Horizon Limited can carry forward to 31st March? So answer is 21. That's the answer. Easy, go, relax. Next is related to income tax computation, child benefit. Child benefit. Good for revision. Priya has a gross annual salary of 65,000. Obviously, it's your employment income. Okay. Her husband, who has a salary of 30,000, separate income. Husband and wife are separate. Receives a child benefit of 3094 during the tax year 24-25. Now, what is the Priya's child benefit income tax charge for the tax year 24? They are asking just for Priya. So now they are just trying to confuse you. By giving husband's income. Okay, so you just concentrate on Priya's income. Just concentrate on Priya's income, which is 65,000, because see the requirement. What is Priya's child benefit tax charge? Now wait. You know, for child benefit, I hope you remember when I was teaching, I taught you the new limits. This is 60 and this is 80. Okay, and this is the limit of ANI. Whenever you find a question of child benefit received, you just have to think one thing, that whether you need to return it or not, or consume it, whether you need to return it or not. Okay, and for this thing, this is the part, these two limits must be used, 60 and 80. If your ANI is less than or equal to 60,000, then consume it, no need to return. Consume, eat it, all the child benefit. But if your ANI is more than 80,000, then you need to return 100%. But if your ANI is between 60,000 and 80,000, then you need to return it by applying a certain percentage on your child benefit. Okay, so in this question, this lady's ANI is 65,000. Sir, why you are saying ANI? Because this is the only salary. Listen, this is the salary. No other income means this is the total income. No gross PPC and no gross gift aid donation. So this is your ANI. So that means your ANI in this question for this lady is 65. Now, yes, 65 means it's in between 60 and 80. So less limit, just subtract the limit is 60,000 and the excess is 5,000. So now let's recall the rule. What about according to the new rules? Excess will be divided by 200. Excess will be divided by 200 and multiply by 100. divide by 200 and multiply by 100. Okay, so this is going to be 25%. This is going to be 25%. Okay, so now you need to return 25% of your child benefit. 25% of your child benefit. Tell me how much child benefit you receive. See the screen, 3094. So the return amount is 3094 times 25%. 3094 times 25%. Okay, it's going to be 773. This is the answer, 773. Okay, so 773 child benefit needs to be returned. 773 child benefit needs to be returned. Okay, let's move to the new question. Let's move to the new question. Now, okay, so we are talking about identify by clicking the appropriate box of the tax treatment. So it's about exempt and taxable income. Exempt and tax. There is a list in your book as well and study hub. Interest from UK building society account, it's taxable. Yes. Premium bond, exempt. If you got a benefit, you got a price from premium bond, it's exempt. Interest from national saving and investment certificate is exempt, but yes, national saving and investment bank account is taxable. Treasury stock interest, it's taxable. So these two are exempt. So it's very simple question. Then Sarah has taxable trading profit from self-employed. Self-employed means it's a trading income, taxable trading income for the year ended 5th April 2025. During the tax year, Sarah made a gross PPC of 6,000. What are the Sarah's class 4 NIC? Now this is the dodge. See, this is the dodge. For class 4 NIC, my respected student, listen. For class 4 NIC, you just need to seek tax adjusted trading profit, taxable tax adjusted trading profit. That's it. There is no role of gross PPC, gross personal pension contribution they are giving you for dodge. Okay, so class 4 tax adjusted trading profit are 78,500. Now let me do it for you. These are the rates. See, these are the rates. Your $78,500. Now very easy. The first band is 0 to 12570. Then the second band is 50270. And the third is, okay. So out of 7, the first band capacity is 12570. If you pick this first, your trading income is 78,500. Very easy. This is tax calculation. Trading income is 78,500. You will knock the first band. So yes, complete first band will be consumed 12570 multiplied by 0%, it's 0. And out of 78,500 we have calculated tax on 12570. So 65930 is left. Now the capacity of second band is 37,700. The capacity of second band is 37,700. The capacity of second band is 37,700. Okay, so you will pick 65930 and you will knock on the second band. Okay, complete second band will be consumed. And yes, the tax rate for second band, see this, it's 6%. It's 6% for class 4 NIC. So 37,700 into 6% is 2262. It's going to be 2262. Now last. Out of 65930, we have calculated tax on 37,700. So how much is left now? How much is left? It's 659 minus 37,700. 28230. 28230. Definitely this 28230 will fall in the last band. It's unlimited band. So 28230, and the last band tax rate is 2% for class 4 NIC. Okay. 564.6. 564.6. You can write 565. Okay. Now please add all these three. So it's going to be 2827. It's going to be 2827. This is your class 4 NIC. This is your class 4 NIC 2827. 2827 is your class 4 NIC. I have also showed you the rates. Okay. Now, next one is, this is the answer. Next question is, Felix worked full-time overseas, very important, full-time during the tax year 24. He was UK resident for the tax year 23-24. Hope you remember there was a topic in individuals. In individuals, there was a topic of UK residency. You are resident or non-UK resident, resident or non-UK resident. And in that topic, the first area is compulsory, or we call it automatic non-UK resident. Sometimes people became automatic non-UK resident, right? And this is the first test. This is the first test. If you hit this test, then no need to go forward. No need to go forward. Simply put the stamp on the guy. Put the stamp on the guy that this guy is compulsorily or automatically non-UK resident. Okay. And for that thing, let me show you the real notes which I teach in class. These are the notes. See, so that it will be easier. See, this is I taught you in the class. Just read it. A statutory test for, see, it's a revision for you. A statutory test of residence has been introduced to determine persons each tax year. The following people will automatically be treated as not a resident in the UK. If you hit only 1 point out of this 3, not all 3, only 1 point, you will be an automatic non-resident. Listen, a person who is in UK for less than 16 days, whatever your name is, if you stay only 16 days, you are a non-resident. That's it. A person who is in UK for less than 46 days during a tax year and who has not been resident during the 3, for this second point, last 3 tax years, you are non-resident, and now you are staying less than 46 days, again you are non-resident. A person who works full-time overseas, this is the requirement, full-time overseas, subject to them not being in the UK for more than 90 days during a tax year. You work full-time overseas, you have a proper job or something overseas outside UK, and now you are staying in the UK for less than or equal to 90 days, then you are still be a non-resident. So this is the case. This third point is tested here. This guy is working full-time overseas. So now maximum he can stay 90 days. If he is staying 91 days, then he will become resident. Okay. So if he or she wants to be non-resident this year, if she or he wants to be a non-resident this year through automatic test, then max he or she can stay 90 days in the UK. If you stay 1 more day, you will be resident. Then more complications will be applied on you. Okay, let's read. Don't see. Felix worked full-time overseas during the He was UK resident for no matter. What is the maximum number of days which Felix can spend in the UK in the tax year 24-25 and be treated automatically, see, not UK resident for that year, so it's 90 days. Maximum he can stay 90 days. That's the answer. Okay, now next move, IHT, inheritance tax. Maria died on 22nd of March 2025, leaving a chargeable estate. Chargeable estate means chargeable death state. It's death state, okay? This is death state, okay? Of 495,000, and this question is about this death state. She had made gross, thank God they are giving you ready-made gross chargeable CLT. Gross CLT of 83,000 on 1st June 2023 and 47,000 on 7th April 26, very far away. Now, how much inheritance tax payable in respect of Maria's chargeable estate of, only we need to calculate tax on this chargeable estate, okay? Now wait, let me make sketch for you. She died on 22nd March 2025. First of all, go back 7 years, 7 years rule. So it will be 22nd March 2018, okay? 7 years back, it's 2018, okay? Now your death state is how much? 495. Your state is 495. And now in past 7 years, is there any CLT? Yes, there is a CLT. There is a CLT in 83,000 on 2023. This is 2023. And yes, there was a CLT in April 2016. There is a CLT of how much? I think, wait, 47,000. Now use your brain. Simply use your brain. You remember the 7-year accumulation principle. This is the date of death, 22nd March. So we have written the state means death state. Simply calculate the tax, 495,000. Now, for any normal individual, there is an NRB. Remember nil rate band, your favorite. NRB is 325,000. Simple NRB is applied 325. But NRB, hope you remember the 7-year accumulation principle. For death state, listen by word, for death state NRB calculation, you are staying here. Right now you are here, and you will see in last 7 years, did you calculate tax on anything? Yes. In last 7 years from the date of death, because we are talking about death state. Did you calculate tax on anything? Yes, this CLT. So yes, this CLT must have consumed your NRB. So it is 83,000. Okay. Now how much is left? How much is left? 242. 242 NRB is left. So yes, 242 will be used for death state. 495 minus 242 is 253. And yes, there is a flat tax rate of 40%, which means it's 101,200. This is your IHT on state. $101,200. Okay, 101200. Next we have COP Limited provided the following benefits to one of its employees. So it's related to employment income. Okay, private medical insurance, yes, it's taxable. This is taxable. Private medical insurance is a taxable benefit and it's a non-cash benefit, remember. But Lucida made a claim during the tax year and the insurance it's no problem. Only employer has given you insurance, and whatever employer is paying for that insurance premium, this is taxable benefit for you. Later on, when you claim you got accident, you got sick, and you are going for medical benefit, then it's not taxable, just the original amount. Later on, when you are claiming the medicines and something, there is no benefit, taxable benefit. Only the taxable benefit is 1400. This taxable benefit, this is your taxable benefit. If your employer is giving you private medical insurance, this amount is taxable benefit. Okay, number 2, cash vouchers costing 2500. Cash, openly they are saying cash vouchers. Now let's read the requirement. What amount of class 1A national insurance is payable by CARP Limited of the benefits provided for the tax year 24-25? Now, if your memory is good, class 1A NIC, the burden of class 1A NIC is to be borne by employer. Yes, we all know that, and it is written here, but it is calculated on non-cash taxable benefit. It is calculated on non-cash taxable benefit. So out of these two, only private medical insurance is non-cash taxable benefit. Cash vouchers, they are openly saying cash, so it's not a non-cash taxable benefit. So for this question, only this amount, this 1400 is your non-cash taxable benefit. And if you remember class 1A NIC, it's 1400 into class 1A NIC. What are the rates? Simply non-cash taxable benefit multiplied by 13.8%. So 13.8%, that's it, done. But non-cash taxable benefit, so its answer is, the answer is $193. Okay, now only 2 MCQs are left, easy. So one is about personal pension PPC and the other one is for corporation tax, easy. Buffy has adjusted income AI, it's not ANI, it's AI, hope you remember the pen, of 280,000 for the tax year 24-25. During the year she made PPC, personal pension scheme, 85,000. Okay, Buffy has no brought forward unused annual allowance, so only he or she has current year annual allowance, no brought forward annual allowance from past years, current year. And you know, current year annual allowance is now 60,000. Okay, but wait, your current year annual allowance is going to be reduced by AI, adjusted income. Okay, right? Now wait, let me make that sketch for you. 0 to 260,000, this I teach you in the class. You have fixed annual allowance of 60,000. If your AI is between 0 to 260, you have fixed annual allowance of 60. But if your adjusted income is more than 260 and less than 360, there will be a reduction working. I'll teach you, don't worry, I've already taught you in the class. And if your AI is more than 360, then fixed annual allowance of 10,000 is available. Fixed annual allowance of 10,000 is available. Now Let's do this question. In this question, you have your AI, your adjusted income is 280,000. Now use your common sense. Yes, AI is 280,000, adjusted income is 280,000, means more than 260 and less than 360. So let's see how much is more than the limit. The limit is 260, right? So just take, how much is the excess? The excess is 20,000. And now what you do, you just do divide by 2. Excess divide by 2, this is 10,000. This is 10,000. Now wait, your normal annual allowance for 24-25 is 60,000. Your normal annual allowance for 24-25 is 60,000, and it will be reduced by 10,000. So how much is the available annual allowance for 24-25? It's 50,000. Now wait, now relax. We have just calculated the available annual allowance. For this question, your available annual allowance is 50,000. Your available annual allowance is 50,000. Just see the working again. Now, my dear student, respected students, you know, in the pension question, if you have studied from me, if you have done the classes, in the end there is a box. I used to make a box for return working, how much pension relief you got. So in this question, you only got this pension relief, this PPC relief. In this question, you got this relief, PPC, 85,000. There is no employer contribution in any pension scheme, or there is no employee contribution in occupational pension scheme, only gross PPC. So let's do that return working. Remember a box? I used to make a box. Let me recall you that box. Return working. So you have only one thing in this question, that is gross PPC, or sometimes we call it TRC, 85,000. And yes, this gross PPC is less than your available annual allowance. Tell me, how much is the available annual allowance for this question? Is 50,000. Oh, as a student, you may ask, sir, is there any brought forward? Is there any brought forward unused annual allowance? No, the examiner has clearly stated no. So how much is the excess? So you stepped out. Remember my word, yes, you stepped out. So excess, and yes, for this excess, you need to pay annual allowance charge. For this excess, you need to pay annual allowance charge. And yes, just for your knowledge, let me tell you, this excess will be treated as a non-saving taxable income. This excess will be treated as a non-saving taxable income. Yes. Now the question is done. Just wait 30 seconds and I'll move the screen. What is the amount that will be subject to an annual allowance charge in the Buffy's income tax calculation for tax? Yes, it's 35,000. This is the answer. It's going to be 35,000. We have just done it. Now the last, Apex Limited owns, this is about Capital Gains Group, hope you remember it. Apex Limited owns 85% of the ordinary shares of B and 100% of C. Let me make this sketch for you. We are A company owns 85% of B and 100% of C. This is the structure, okay, initial structure. Now, Bridge Limited owns 75% of D. B Limited owned 75% of D, and C Limited, Catalyst Limited owns 60% of E. That's it. Now, which of the following are within the chargeable gains group? That's very simple, very simple, very simple. Listen, for chargeable gain, capital gains group, what are the requirements? For at each level, the holding must be 75% or greater. 75% or greater. Okay, this is the first requirement. So, yes, this is greater than 75, this is greater than or equal to 75, and this is also. But see, from C to E, the direct holding is less than 75. So just cross E. E is out. Okay. So this is the first requirement. At each level, the direct holding must be equal to or greater than 75. Now the second requirement, for indirect subsidiaries, the effective holding should be greater than 50. See, this is your direct subsidiary. This is your direct subsidiary. But see, D is the indirect subsidiary. D is the indirect subsidiary. So let's calculate the effective holding. Effective holding is the product of these two direct. So 0.85 into 0.75. Let me do it. 0.85 into 0.75. It's, yes, this is 63.75%, which is greater than 50. Okay. So D is also the part of this group. So C, B, A, B, C, D, A, B, C, D, A, B, C, D, part of capital gains group. But yes, E is not the part. E is not the part of capital gains group. E is not the part of capital gains group. Are you getting? Okay, so answer is A, B, C, D. Which companies are C? They have written A, so B, C, and D. E is not. E is not. That's it. That's the end of today's class. And see, this is the pre-mock, latest pre-mock. If we can do together, you can also do it. It's all about concentration. It's all about looking at your target carefully. Okay. So best of luck with your paper. And I hope you will, if you like this class, please comment on this class. Do share it with your friends. Thank you and take care.